another week and another new all-time highs. So that's good. We kind of came out of this consolidation period on the NASDAQ, finally broke all-time highs. It's still struggling though. It's not breaking out like the S&P is. I think coming out of the lows we saw in April, I think the NASDAQ really ripped hard, and now we're just seeing a bit more consolidation relative to the other indexes as they catch up. So I think pretty soon here we're probably gonna get the Nasdaq to start being an outperformer. Like for example, today the S&P performed better than the Nasdaq, but when you look at it on a year-to-date basis, the Nasdaq is still performing better. But I think it was just kind of getting too far ahead of itself, so everything had to catch up a bit. That's the way I see it, at least. What about you? What do you think?
I think that the market probably the Nasdaq if we're going to go into a true rotational shift here where risk on accelerates, right? Um, I think we're going to see a situation where the Nasdaq's an outperformer. Nasdaq small caps are outperformers.
Yeah, and I especially small caps. I like if we do get a melt up here, small caps should outperform, especially with all the rate cuts on the horizon, and even with the talks of a 50% cut as well. Like that, I know that's not being priced into the market, but there there is a small chance being priced in. So maybe in future meetings, maybe closer to the end of the year or the start of next year, that could be something that happens, which that would definitely boost small caps, depending on what the reason is for that 50 basis point cut.
Yeah. So my thoughts on a 50 basis point rate cut. So I'm in the camp right now that the Fed does need to bring policy down somewhat, but I believe at the rate at which they need to bring policy down has to be very calculated. And we actually have we're going to be putting up a ledger post, a blog post on this tool, but we have a neutral rate a neutral rate estimator tool, basically our internal neutral rate forecast of where we believe neutral rates to be, and versus the benchmark rates. So, for example, our neutral rate estimate is based on it's benchmarked to the 2 year. So you can see as to where the 2 year yield is versus our neutral estimate. So if the 2 year is above the neutral estimate, you're in restrictive territory. If the 2 years below the neutral estimate, you're in accommodative territory, right? So we can look at this a bit deeper by looking at it on a policy monitor basis, and all that does is it takes the spread for you and just graphs it. So again, if the if the neutral rate premium is negative, it implies that the 2 year the neutral rate itself is below the 2 year. So the 2 year treasury yield is above the neutral rate, implying that so basically the reason why we're benchmarking to the 2 year is that's typically the Fed's most Fed has the most control, at least going on to duration up to 2 years. That's where their forward guidance really lives. Obviously, it can go further, but then you get more term premium, you get more volatility, you get more exposure to just duration, right? The market is going to drift more. So up to 2 years is what we like to look for in the cycle of Fed guidance, right? So where can we see the Fed guidance in the 2 year yield, and then what does it compare to towards our internal neutral estimates? And when this premium is negative, or it's a discount, right? What it implies is the neutral rate is below the 2 year yield, implying that the Fed is hawkish. Their forward guidance is above where the market's pricing in a neutral rate. And that makes sense back to 2023, right? We were in negative territory here on the spread for pretty much since 2022 all the way up until, matter of fact, earlier this year. And around the start of this year, we go up into positive territory, which indicates that based on forward guidance, the market is currently priced about one cut below neutral on forward guidance, based on the Fed's forward guidance. So this implies today, if the Fed were to deliver all of the cuts priced in and nothing were to change in the economy over the next couple of years, right, or the next 2 years, the Fed would be in a loose or non-restrictive state. It's very simple. Green is easy, red is tight. So when you're in green and you're in green territory here, it implies that the Fed is priced to be accommodative, right? And the problem with this is inflation's still above target. So this is the first time this year was the first time the Fed got back to easy-ish policy since they started the hiking phase in 21, 22. So we're now back into this easy state. And primarily the driver for all of this was initially, right, in Q1 when this ripped, was the weak GDP. Was when we went negative on GDP because of the whole Liberation Day. That's when neutral rates fell originally, right? And we can just look on this on a neutral rate estimate, right? So neutral rates fall in April, right? And then they come back, and then they fall even more with the recent weakness in labor markets. And the benchmark's actually below the neutral rate. So it's implying that the Fed is easy, right? Go back to the spread, it's green, easy. And we'll have a whole write-up on this on our website in the coming day or so you guys can go back and check and read and exactly figure out, we explain how we calculate this. It's open source. This is free, so anyone can log onto the website and read this real time. Now, with that being said, I think the Fed needs to be very careful here with how they guide, how they issue forward guidance, because this is going to be an SEP meeting as well. So we're going to get the dots updated. We're going to get their internal forecasts updated, etc. And I think that how the Fed guides is going to give us an indication as to, is this already too easy, or is it going to get even easier? And typically, if the Fed, so right now this is the curve implying that the Fed's going to deliver, periodic rate cuts in line, no 50s, 25s here and there. If the Fed were to deliver a 50 basis point rate cut, I think they're going to blow out the neutral premium even further. The neutral rate premium is going to get blown out even further. And the further the neutral premium rises away from neutral, it implies the looser and looser the Fed is. And that, I think, opens up the door for melt-ups. That's where melt-ups happen. Melt-ups don't happen when the Fed's in restrictive territory. Melt-ups happen when the Fed is super, super easy. And when I say melt-ups, I'm not talking about just the NASDAQ going up, right? Melt-ups are when, like, small caps are ripping. Like, think of it like this. Let's go back to 2021, right? When everything was super easy. Money was flush. Everyone was ripping. Like, look where the neutral premium traded up to. Implying the Fed was basically, at one point before they started hiking, over a percent or so below the neutral rate at zero, right? Neutral rate was at 1.3, 1.4. The Fed was at zero. And this is when small caps did their best up until this point. And small caps have pretty much done nothing spectacular ever since the Fed went hawkish. And I think the Fed coming back to neutral / accommodative territory opens up the door for a broader range of assets to rally. But the question here now is, are we going to make a policy mistake? Because the policy mistake is letting neutral drift too high, too fast without getting inflation under control.
Yeah,
that's a policy mistake.
All of the other times, except for in 2020, they had higher neutral rates, more easy conditions, but inflation wasn't an issue back then.
Right. So if we take a look at just where neutral is right now, right, the neutral rate peaked around 3%. Our estimates were in 2018. And right now it's at 3.74%. So neutrals are, market-based nominal neutral rates are higher. And what this is saying is that the Fed can't cut. If the Fed were to cut rates in the next 2 years and everything were to stay the same as of right now, down to where rates were back in 2018, they would be excessively loose. So for this to make sense, for you to get this master rate, because remember, at the end of the day, we trade the markets, bonds, everything trades off of the forward curve. And the forward curve, the 2-year curve, right, has all the Fed policy already priced in. So when you make a bet, you're betting that, like, if you think rate cuts are going to be bullish, you're not betting on the Fed cutting rates. You're betting that the Fed is going to cut more than what's already priced in. So as of right now, what's priced in isn't too bad. We're not that loose. I mean, we are accommodative, but like we're not necessarily extremely loose like we were in other periods over the last, 15 years. So this isn't terrible, but the question now is, does the Fed let this get out of control? And the way that they can do that is, for example, cutting 50 basis points, being very dovish. And it does seem like um, they seem to have this notion to be very sensitive towards labor. And I wrote a post about this earlier today, but I think it has to do primarily due to central bank dynamics, right? Because a Fed governor can only be on the board for 14 years, right? That's their term limit, 14 years. So by definition, there is nobody on the at the federal there is nobody at the Federal Reserve in the Central Bank of the United States that has been around in an environment where deflation was not a main concern. Everybody that's setting rates today came in at least after 2011, right? So that implies that they were not on the board pre-GFC. So there's nobody that's been on the board, right, in an environment where you have an economy that's consistently running above capacity. And my theory is that the Federal Reserve has been trained internally over the last decade, 1.5 decades, to prioritize labor market weakness at all costs. Because in an economy that's not running above potential, basically an underutilized economy below capacity, the labor market shocks are pretty much directly translate into negative growth and deflationary spirals. Like if you're running under capacity, the economy is already fragile, weak. Labor weakness propels to GDP weakness rather quickly. But in an economy that's above capacity, you can actually have sustained patches of labor weakness without taking away from growth because the economy is already filled to capacity. So you're not really running the economy below potential. And this is a phenomenon that we've experienced it many times over history, but the central planners in office today have not seen an environment like this up until post-COVID, which is why the whole reason the Fed was transitory post-COVID when they let the policy premiums blow out like this was because they thought that the economy was in a very weak state post-COVID, and they were afraid of cutting the stimulus short and sending the economy into another prolonged post-GFC negative output gap scenario where the economy is running under potential, right? And let's see if we can pull up let's see if we can pull up one of these, make it nice and easy to understand. So when I talk about the output gap, this is what I'm talking about. Above zero, the economy is running above potential. And this happened into COVID, but primarily we've been consistently above zero post-COVID for the last, 4 years. And after the GFC, recessions reset the economy. They take a chunk out of capacity, and you basically start with an economy below capacity. It happens in every single recession. This is what defines a recession: an economy running below capacity. That is the definition of a contracting economy. You are in a recession. So after the GFC, we were in such a deep contraction that the Fed and everyone were so concerned that we would not get back to a imbalanced economy for so long that any sort of labor weakness was always met with rate cuts. Was always met with either rate cuts or persistent QE, whatever it may be, dovishness, refusal to hike rates, whatever the case may be. Now, what happened after COVID, we went to a negative 10% output gap, literally the largest in the series record. So the Fed was very, very afraid, again, trained on this post-GFC style where you have an economy weakened and fragile, running below capacity. You don't want to stunt its recovery. So that's why the Fed was so hesitant. And the output gap goes positive in Q2 2021. And notice that roughly around 2022 is when the Fed finally comes to the table. Again, waiting. They're late, etc. We understand, but they let inflation run hot for a while because the economy was in the recovery stage. So the Fed as an organization, they're not accustomed. Everyone in the Fed at least had to come in after 2011. So they haven't spent much time. the Fed board members pre-GFC, there was a lot of experience with this. Even 99, we had massive output gaps into the dot-com bubble, right, when everything heated up, and you get melt ups when output gaps are positive, right? That's when you get the melt up. Go back to 2021 when everything went crazy, right? It was the fast and wicked and like whipsaw and recovery here to positive territory, positive output gap, moderate, easy Fed, strong, very high neutral premiums, economy's ripping. So you're in an environment here that's primed for a melt up if the Fed acts, or if the Fed missteps with the policy mistake. If they cut too quickly, too easily, because they're afraid of labor, they open up the doors for a melt up.
Yeah, and we haven't seen a situation like this since like the late 90s. Like, if you guys haven't read the newsletter that we wrote up about the labor dynamics at the moment, it's the latest one. You should definitely read that because we dive into productivity, and you have growth that comes from three different areas. You have productivity, you have jobs being added. So that's what we watch with NFP. And then you have time. So if people work more, there's more output. And we're now entering a stage, well, we've been in a stage the last few quarters where productivity is actually taking the lead. And that's why the market didn't react when we had that negative 900K revision to the jobs numbers earlier this week, because we don't need jobs to increase the output as we normally do in over the last 2 decades. Last time we saw this was in like 95 to 98, something like that, where you had consistently decreasing NFP, but consistently increasing productivity that was keeping the output continually elevated. And that's a good sign of a very strong economy. And yeah, these Fed board members, they've never experienced that.
Yeah, they obviously they were alive, right? These are older people. They were around for these environments as human beings, but they never had to set policy in these environments. And the point I'm emphasizing by mentioning that is you have Fed members that are in the organization, or at least at the role of being able to set interest rates and being trained by predecessors who, Janet Yellen, etc., who are that individual. Janet was probably more exposed to this than Powell, but still, this fear of deflationary shocks. So when you see payroll growth getting revised down by 50% over the last observation period, right, from March to March, you think, okay, payrolls were understated by 50%. That's obviously dovish, right? The Fed has to react because that's a very bad sign for the economy. And that's especially a bad sign for the economy when you are not at capacity, because that's just insinuating that the economy is rolling over without even recovering. And that's why if you look at this from another dynamic, right? Look at it like this. For this entire time, the Fed was doing QE, right? So think about it like this. The Fed was doing QE from pretty much post GFC all the way up until 2016. I think they started raising in like 2014, 16 in that area, right? So rates were so low for so long. Now let's go to take a look here at what inflation was doing during that time, right? So let's see if we can go all. It's going to be a big series here, but let's just see if we can pull this in. Okay. So 2015 to 2016. What you'll notice here is inflation could barely, there were some short spurts, it barely held 2%. Fed was doing QE, fiscal stimulus, right? Money printer go burr, it's all a joke, right? But we could barely hold 2%. Fed was at zero for most of this time. So why is inflation not falling the same way? And our theory behind all this is the output gap. The Fed is in a completely different position now because the economy is at or above potential. And in our recent ledger post, we talk about the uprising of artificial intelligence, and there's some theory to be had here that The output gap here is probably overstated a bit because the way the output gap is calculated is you take the gross domestic product and you compare it to the potential gross domestic product, which is an estimate. So it's the estimated potential gross domestic product at 100% capacity. And these numbers don't get updated every month, but they do get updated frequently enough. The problem is AI comes in around 2022, which is right around here, and output via the output gap actually rises since the Q3 ChatGPT Genesis. So output gap is up like 3 or 4x since then, right? In terms of value. I think that there's a probable case to be made here that the denominator here being that real potential GDP estimate widened. So AI in a fragmented way has flown through the economy and opened up new doors, opened up new capacity, right? Provided new opportunity. And what it's done in a way, because we know that the AI domination is deflationary by nature, right? If AI were 100% efficient, AGI was here, nobody would have a job in theory, right? Or there would be a lot less available jobs, be deflationary. But I think that the way that AI is being taken up into the economy, it's very fragmented. You have the economy is full of young and old people. Old people might use ChatGPT sparingly, and maybe they just use it as a Google search alternative, right? To summarize simple things, recipes, etc. Right? Basic things. Meanwhile, you may have a small coding team that's using LLMs for code-based work, right? And they're building enterprise apps. So how AI as a whole gets absorbed into the economy is probably fragmented and it's probably going to take some time to play out. But I would bet that it has opened up more opportunity or capacity in the economy. So I think that output wise, we're probably not as overstated. And therefore, the Fed can likely cut rates a little bit, which is why we're seeing neutral estimates like we were talking about earlier falling, employment slowing. But we're still at a point that is up at or above capacity. So when I say that output gap is probably overstated, I'm not saying it should be negative. If I had to guess, just cut this number in half. Still positive, right? That's what I'd say we're at. And in that sense, we still have very strong, robust growth. We have strong production. We have strong general output. So what that implies is the Fed can ease policy a little bit without really stoking inflation, but they can't go too far. Because for the Fed to get as weak as everybody wants them to be, you need a recession. And remember this, it is impossible to get a recession with a positive output gap. Mathematically, economically impossible. What happens is a recession comes about when the output gap goes negative. So as long as this does not cross below zero, you are not going to get a recession. That's just how it's going to be. And what you can chalk this up to here when NBER is saying that recession started in Q4 2007, the output gap was probably overstated. And notice that for them to get the recession, we did have to go to negative territory. So again, could this be the top? Could we be rolling over? Anything's possible. I don't believe that's the case. But unless we actually go negative, there is no recession. There won't be. It's impossible.
Well, so if the Fed's in a position right now where they're able to cut and they also cut at any sign of weakness, if that's what they're looking for labor market deterioration. Do you think we can get a repeat of last August when bonds rallied but then fully reversed because they just panicked too quickly when the SAM rule triggered and then ended up actually making the economy run even hotter?
I think that's the dilemma we're going to face for some time until what happened. This ends as long as the output gap is positive the way it is and growth is running where it's at. This ends with the economy running so hot that it burns out, like in dot-com bubble. That's what happens. The economy runs so hot, it burns out, and it collapses, right? And that eventually, that's how the economic cycle happens. You have booms, you have busts, right? So I think that the environment you're in right now, as we were saying earlier about the Fed setting policy with above capacity economies, you're in a position now where the Fed is faced with their old dilemma of being so reactive to patches of labor market weakness that it's almost better for them to let the economy cool down before moving policy too much because they have such a large cushion. They don't need to be so reactive to labor weakness, but it seems like they are. So what that means is if your economy is above capacity, by definition, you're producing more than its potential. You're putting upward pressure on inflation. In theory, labor market weakness will only bring you down to balance up until they become too weak and they accelerate even worse from there, right? Moderate labor market weakness only brings your economy up, down to neutral, where it's not really above or below capacity. But the problem is those waves of weakness, which should just balance the economy out, come up with additional easing from the Fed because they're so afraid of deflationary events. So to answer your question, yeah, if the Fed gets too easy too quickly in an economy that's above capacity, it implies that they're easing into windows of weakness that can get reabsorbed pretty quickly back into the economy. Which is why, if you take a look at the unemployment rate and you look at where we are right now, the unemployment rate has drifted from 3.4 to 4.3%. The stock market's at record highs. The bond market's still in the dump, right? Bitcoin is up above 100K. Why is the economy not deteriorating with the unemployment rate drifting from 3.4 to 4.3%? Why are we not seeing a significant, let's just go back to GDP, right? And let's just go out over the last 10 years. Post-COVID, we saw a little bit of a hiccup in 2022, but after that 2022 market correction, GDP has been pretty constant. Outside of the Liberation Day dip, GDP has been pretty constant around 2%, real 2% plus per quarter annualized. So why is this happening if the unemployment rate is drifting up? Where's the weakness? And my theory is that the economy is just it's able to absorb higher unemployment rates without necessarily hurting growth because it's already above capacity. So I think that you can see in an environment where the unemployment rate could even drift somewhat higher, and it's still not entirely problematic. At the end of the day, we're still below the last S&P medians for this year. We're likely not going to put in, there's 3 months left, three unemployment prints left in the year.
Yeah, and they had
right?
4.3 median unemployment for the
No,
year.
4.5. 4.5.
4.5.
Yeah, and we're at 4. That median meaning that we'd have to be, above 4.5, and we're at 4.3 right now. So SCP comes out later next week, and we'll see what they estimate. But I'm assuming that they're going to have to revise those numbers down for this year because we're not going to hit that. And next year we'll see where the median is. But it implies the Fed was already expecting a weaker labor market, and we haven't gotten that. So the labor market's weakening, but it's doing so with an economy that's somewhat over its skis, right? But not so far where it's falling over. It's just basically moving faster than its capacity. So a little labor market weakness doesn't mean the economy is going to roll over. And I think that's the problem here. The Fed is trained to get so dovish so quickly on spurts of labor market weakness that all they do is they open up the door for the reacceleration windows for it to run even hotter. And that's the dynamic that I think that many people are all caught up with labor, but they're not looking at the other side of the equation, which is output, right? You're looking at the units to generate the output, which is labor, people, but you're not looking at like what's actually being put out in the economy. And as long as the output is high, labor can be a wish-wash, and as long as your output is consistent, stocks care about earnings. Stocks care about cash flows. Stocks don't care about how many people are in the workforce. Stocks only care about how many people are in the workforce if it affects growth. And so far, you've seen the unemployment rate drift up like a whole percentage point, and growth is still consistently 2-3% real. So that's why the market's not concerned. It's when unemployment breaches a fold that it bleeds into growth. And that's what happened in the dot-com bubble. What happened was, going into the dot-com bubble, payroll growth started to fall off a cliff. And productivity in recessions, it picks up. It doesn't necessarily go negative, but it offsets a lot of, productivity rises in recession is a standard rule, and it proves that way over time. So what happens is payrolls start falling, productivity's share of contribution output picks up, but payrolls fall to such a point that the contribution from productivity increases cannot outpace the deductions from payroll losses. And that's when the economy rolls over, especially when you're running a 2.5% output gap. The economy was way beyond its skis. It hit a point where it couldn't get any hotter. It's like it basically, the time was so good, things were going so good that it possibly couldn't get any better. There was only downside. And that's when the dot-com bubble blew or popped. And you're in a position right now where payrolls have been weakening, productivity's coming up, but payrolls aren't necessarily at a point where they're taking away from productivity. And given how sensitive the Fed is here, the Fed can actually reignite payroll growth, open up the door, and then you end up in a situation where productivity re-ramps or output re-ramps because you have productivity being held so high, and then payroll growth gets added back into the equation. And output gap rises as well, runs even hotter, and that's the true melt-up. If the Fed becomes too accommodative to an economy that's already above capacity. And that's the risk here. That's the risk that's being played out in real time. The Fed cutting 50 basis points only accelerates that risk. The Fed becoming more dovish than they already are only accelerates that risk. Going well beyond neutral is too accommodative, accelerates that risk. So that's where you are right now, I think, in the economy.
I think this is probably like the most bullish I've ever felt in my life.
Yeah, I mean, I'm pretty bullish too, but I do know that what we have to keep an eye on here is the risk next week. Like, everyone's talking about 50 basis point cut. It's obviously not priced in, but if the Fed always did what was priced into the market, we've seen it happen before where odds change quickly. If the Fed doesn't cut rates for whatever reason, I think we have a problem on our hands here. Because I think the market at least is moving at a pace here. And when I say a problem, a short-term issue. If they don't cut 25, I think the market snaps back.
Yeah, I think it's just going to get priced in further down the curve.
Yeah, probably. I'm not too concerned about that probability, but let's put it out this way. In the market, there is no such thing as zero chance. There's no such thing as a zero probability of it happening. Especially in this environment where any reasonable central banker would look at the situation and say, okay, the economy is still hot, GDP is still hot, payrolls are getting revised down, but we don't necessarily need to be so dovish so quickly. We can still wait a meeting and react or whatever it may be. Now, it would be, I think, neutral to the economy if the Fed cuts is already priced in. The question then falls on their forward guidance. So odds are, I think the Fed will cut. I am a little concerned if they don't, but I'm not thinking that's going to happen. It's not zero probability, though. I think that the probability of them cutting 50 basis points is slightly higher than them not cutting at all. But I think the highest probable outcome at this point is they do cut 25 basis points, and forward guidance is going to be key. Are they dovish? Are they hawkish? How they move the curve after that will really give us the indication as to how weak they are to the point of making a policy mistake. Because I think that's what ignites the melt up, a policy mistake, especially a series of policy mistakes. This idea, making a policy mistake and then sitting on it would be probably a compounding mistake where they cut too much, right? The economy reaccelerates, like we were talking about what happened last summer. Yet they just go back to the state of where we'll sit and we'll just wait it out. They'll claim it's restrictive policy, moderately restrictive, whatever they want to call it, and they'll sit on it until it becomes restrictive again, right? And I think that if you drop policy to a certain point where the economy is running, you're going to actually run the risk of having to rehike. That's what I think the biggest risk is, of being too dovish. And that's where the policy mistake happens. The big policy mistake, the one that compounds. They cut too quickly or too much, then they sit and wait, and that neutral premium that we were talking about earlier, where, it's right now it's positive, showing the Fed is somewhat loose, it starts blowing out. And the Fed's just like in 2021, where the Fed just says, oh, we'll just wait and see. But this time they say, oh, we're moderately restrictive, up until the point where they may have to hike rates. And all that is saying is policy itself, neutral, has found a new floor, right? To think that the neutral rate is destined to go down to zero, to go down to like 1%, given the state of fiscal and given the state of the current output gap. I think that's the mistake. I don't think neutral is going to 1% anytime soon. So there's going to be a floor. Maybe it's at 3.5%. Maybe it's at 3%. But there's going to be a floor here where people are going to expect the Fed to bust through. And I think that that's the dynamic that you're at, where maybe the Fed doesn't understand this either, and they end up cutting as well beyond that floor, and they end up in a position where they'll have to rehike because the economy is running in balance with rates higher. And that, I think, is the risk that's the risk of the policy mistake. They cut too much too quickly, and then they have to rehike, but they're very hesitant on doing that because they don't want to look like fools, and they don't want to have high volatility in monetary policy. They want to be consistent. And that's where premiums, right? We were talking about this earlier, they start blowing up and out, and that's where everything starts melting up. And I think a good start to that policy mistake would be cutting 50 basis points here off the rip, in my opinion.
Yeah, I agree with that. But I mean, the market's pricing in just like what, 6% of that happening.
Yeah, it's not
I
a
doubt.
very
Based on their track record too, there's no way they're going to do that. They've been playing it very safe when it comes to inflation.
Yeah, I don't think they're going to cut. They're going to cut 50 basis points, but I think this candor here of almost a cut basically a cut every other meeting, I think that's probably a little aggressive, right? Given what we're seeing today, maybe it changes, but their forward guidance will probably move the curve a little bit. Again, I'm in the camp. Look, surprises, even with payroll revisions, surprises are in line, if not higher. This is after payrolls too. Like, this is the shock after payrolls. So like, we're still up here. Maybe we fall back down towards zero a bit, but last summer when stuff was hitting the fan, we were way negative, way negative. So I just think on a sentiment basis, that is not bad. On an actual basis, payrolls are weak, but output is still strong. So it's hard to get like super dovish, and the Fed reacting primarily just to payrolls will likely be a policy driver mistake, a policy mistake melt up driver. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X @themarketradar or go to our website at market-radar.com.